Hi, Jason.
Hey, Soren, great to be with you.
Good to see you. And thank you, everybody, for joining in today. I'm Soren Haestrup. I'm the founder of Coherra. And today I'm going to have a conversation with Jason Ehrlich from Fruition Capital. We have never been afraid of going niche in Coherra, and I'm looking very much forward to learn more about your strategy today, Jason. First, we are just going to have a little bit of housekeeping. We already had the disclaimer, and today we're going to talk for about 30 minutes, I believe so. We're going to start with the conversation between myself and Jason, and we will finish off with the Q&A. So everybody feel free, if you have any questions, to put them in the question section. And we will follow up on that if it's something we feel is very relevant. And Felipe, our producer, will ping us and let us know so we can address it in between. But the structure here would really be to get to know more about this niche strategy that Fruition Capital is executing on. So, Jason, welcome to Coherra, and thank you very much for joining today. With niche, there's always a story. There's always been a way into it, and I would actually love if you could explain us a bit about your background and your way into to this asset class.
Yeah, sure. So my background has really been in kind of two parallel paths. I've always been sort of a traditional business guy, if you will. I came out of college and spent a number of years in different corporate roles, went back to business school and was a management consultant for years and held some corporate strategy roles after that. But along the way, I became interested personally in alternative assets just as a way to diversify my own holdings. And initially, that took the form of commercial real estate. And after some years in doing that, I saw an opportunity to become a deal sponsor. And I started doing that in the commercial real estate space. But as I got deeper and deeper there, I continued to spread out my own personal chips into a variety of different asset classes, in private credit strategies and various different things, energy. And of course, eventually you come to operating businesses as an asset class, private equity, being the most commonly known way into that. But maybe 4 years or so ago, in again, just doing my own personal investing, I discovered this space they're calling acquisition entrepreneurship or search, which refers to this dynamic where you've got an established, stable, small business with a retiring owner. In today's world, it's usually a baby boomer, and that business has to transact as that baby boomer, gets old and retires. And the more I learned about the space, and the more I researched it and saw kind of this tidal wave, we call this the silver tsunami, is the name of our webinar here. I was just blown away by how much change there's going to be in the next decade in terms of the transfer of ownership happening from baby boomers to the next generation of business owners. And we'll talk about how our model works and all that, but I drilled in deeper and I saw a significant opportunity where the debt that's used for these transactions is fairly standardized. There's a couple of different options available, but the equity landscape was really the Wild West. And I saw a significant opportunity to pick up my years and years of business background with my roughly decade as an investment sponsor, albeit in different asset classes, merge those together, build a team, and create a firm that was really going to focus narrowly on, as you say, this tight niche of investing in entrepreneurs who are going out there to acquire stable small businesses. And that's what we do now.
Fantastic. Thank you very much, Jason. So I think this business of purchasing, smaller businesses is a very American thing. And maybe maybe we should start with the macro landscape of this. What the demographics, the changes, the retirements. I mean, what's the magnitude here? Because I think it's certainly unique, and of course, it's also a question about where you define a small business. What's the alternative for a handover or sell as a private business. But could you how does it look through your lens, the macro landscape?
Yeah. It's fairly well documented here in the States that small business is kind of a backbone of our economy. Over
Sure.
half of private sector employment comes out of small business. They really make up kind of key part of our economy here. And what we're staring at right now is there is a larger concentration of business ownership among the baby boomer generation than there's ever been in any generation prior. The stat is around 55%. We can comfortably say over half of small businesses in the US are baby boomer owned. And these folks are pretty rapidly aging into retirement. A lot of them have worked later than previous generations have. Their work is their passion, their life. But we're really kind of reaching that tipping point where age and health and family situations are really forcing some of these folks to retire. There's an institute called the Exit Planning Institute, and they actually just published some research recently. And they said 73% of the small businesses in the US will trade hands in the next decade. It's just kind of a staggering figure. In the 5-year time horizon, they said that's roughly half. That goes up to 73% in a decade. And so it's a massive sort of tectonic shift in the ownership of these businesses. Obviously, there's a huge transfer of wealth that comes along with that. But there is a small but ever growing cohort of, they call themselves searchers or acquisition entrepreneurs, but folks who have said, hey, I'm 15, 20 years into my career, often with an MBA, but not always. I don't want to continue to climb the corporate ladder or take the risk associated with starting something from scratch. I want to go out there and just find one high quality business that's been operating for years that I can buy from a retiring owner and sort of pick up the legacy there and continue the growth trajectory of that business.
Interesting. That's really fascinating. So you say 73% is to change hand over the next decade and about half over the next 5 years. That's massive.
Yeah.
How do you look at it through or analyzing the various businesses? Because obviously there are some that are more at risk for disruption or just becoming legacy businesses. Maybe we can go into that later, but I think that's a interesting perspective, at least to have on this. But maybe in terms of your model, so let's go back to the entrepreneur who feels the desire to go out and acquire a business. How is your model in terms of financing, and what's the requirements here in order to get such finance?
Yeah, part of the uniqueness in our model is that we're not actually looking for these businesses to buy. We do have a very specific thesis around the business parameters, and we'll talk to that in a minute. But we do have an entrepreneur first model. And so our team is out there in probably 8 to 10 different channels, constantly trying to find and forge relationships with these folks that would buy the business. And as I mentioned, they commonly look a little bit like me. They've got 15-ish, 20 years of experience. Some are an MBA, some are just mid-career, and they've decided they're going to pursue this path. When we're vetting them, the perfect profile is someone who's run a business, sold a business, they're going to go back in and do it again. But the reality is that's probably only, 10, 15% of the population. Usually we're looking for folks that have worn all the various hats that a small business, owner, CEO, operator is going to need. So have they successfully, led and managed teams of people, run a sales function before, been in the operations side of a business, have comfort with the financials, and of course, obviously we're vetting their references and background to make sure that we're talking about a high integrity player. But we really want to get comfortable with the entrepreneur, the jockey on that front end. And then, as much as possible before there's ever even a deal on the table. And then those folks, maybe it's 20% of the folks that we talk to, and we talk to hundreds of folks, we really feel like they're strongly qualified and they're searching for the type of business that we want to invest in. And again, we'll talk about that criteria in a minute. We stay really close to those folks. And then they'll come to us and say, hey, I've gone through 100 business listings. This is a really interesting one that I'm thinking about pursuing. Do you guys want to take a look? And if the answer is yes, we'll do a full diligence process alongside them. And we wind up coming in on the deals that we select as the anchor investor, which means usually we're writing the biggest check on their cap table, taking a board seat and participating with them on a go forward basis.
So how does the rest of the cap table look like? I mean, the funding, what's the alternative funding they look for here?
Yeah, so usually when you're acquiring these businesses, part of the reason we really like this space is that the valuations are tremendously attractive. You mentioned earlier, how do we define small business? We usually think about it as $1 to $3 million in earnings, EBITDA, so kind of bottom line. They trade for 3 to 5 times multiples. So, if you think about that compared to the US stock market, which commonly has multiples in the 20s, 30s, or above, extremely attractive valuation. And we could talk about, the risk reward trade-off that comes with size. But they're smaller enterprises. The cap table, it's debt and equity, of course, usually maybe 80-20 or so is the ratio. And here in the US, we have a program run by the SBA, the Small Business Administration, which has a loan called 7A. And so the vast majority of these acquisitions are facilitated by the entrepreneur securing an SBA 7A loan, which they personally guarantee. And we like that in our model because it creates an enormous alignment of incentives between the entrepreneur, who's really strapped to the mast of this business. There's no handing the keys back, and we, the investors. So commonly there's a bit of a seller note in there as well, maybe up to 10%, so that the seller has some skin in the game go forward. And then there'll be 15 to 20% of its equity. The entrepreneur may inject a bit, a couple $100,000 or so themselves, and then they'll raise the rest from friends, family, other investors as they can find them. But that is where we saw this sizable opportunity, where the equity landscape in this space was just totally fragmented, and really nobody doing what we were doing in terms of coming in as an anchor investor. And we'll talk about our team a little bit later and the value that we can bring, but we do have the ability, aside from writing a very large check and having some good connections in the space, our team has a lot of experience here, and we can bring a lot of value to them going forward. And so that's kind of one of our advantages as we create deal flow in this space.
Sure. So there's some characteristics of a private equity deal, or where there's some operational involvement as well, right?
Yeah, absolutely. I think, this is very much private equity in miniature. And the model that private equity has proven out over decades and decades works well. But here we're talking about subscale. It's smaller than private equity is interested in. And, commonly these owners who have had the business for 10 to 40 years, it's their legacy. It's been their life. They don't really want to go, and quote unquote, sell out to a big private equity shop. And so having an individual entrepreneur with a face and a family come in and acquire it from them can be very appealing. But, from our perspective, as the strategy pans out, many of these businesses, like I said, they're in this $1 to $3 million EBITDA range. Well, lower middle market private equity can start to play down as far as about 3, and certainly in the 4, 5, and north range. And so part of the strategy, and we don't depend on this, because actually we can do quite well in a scenario of stable, sort of slow growth, which is really what we're after. But many of these businesses, we have the opportunity to buy them and grow them over a 5 to 7 year horizon into the strike zone of those lower middle market private equity players. And in the scenarios where that does pan out, obviously it's a very lucrative exit for the entrepreneur and us as the investors as well.
Okay. So the lens you look through, or your search for these businesses, it's predominantly in the US, at least in your fund one, right? The other thing, what kind of businesses are you looking for? Are you industry agnostic, or are there some that you prefer over others? Not that you need to list the top top 20 over the industries that you like, but are there certain industries that you exclude, or that you just feel this is the strong domain that you add value to?
Yeah, so our thesis and our strategy is around businesses dynamics, much more than it's about particular industries. The reason that we and other investors like this space is that, unlike investing in startups where, you're really taking a big risk, you don't have product market fit, you don't have established customer base and cash flow. There's a very high failure rate, 90 something plus percent of startups failing within 5 years. The reason people like acquisition entrepreneurship is that there's much more stability. There is historical, stable cash flows, customers that buy from you year after year after year, product market fit, all of that. And so we sort of take those things that people like and try to dial it all the way up to 11. So we look for the most stable, enduringly profitable businesses that we can find. And so what that really means for us is B2B companies only. So we're not, any business that's serving directly to consumers is out of our scope, but B2B companies that have a large and diversified base of repeat clients that have been buying from them year after year after year with, long tenure, low churn. It's not RFP bid-based revenue. They just buy from them, whether it's contractually recurring or just reoccurring revenue year after year. They've got a minimum of a 10-year history, and they're not in an industry that is highly disruptible. So think anything in tech just moves, too fast for this, or, any of the more cyclical industries. So think things that are highly dependent on new construction or oil and gas. We're really looking for those boring, slow, old economy type businesses that just churn out year over year. That can look like business services, that can look like light manufacturing, that can look like value add distribution. And we have a little bit of each of those in our Fund One portfolio. We actually are fairly intentional about diversifying by both industry and geography within that parameter of, enduringly profitable business. Okay. You mentioned Fund One. So we were specifically focused on the US geographically in Fund One. We did a post-mortem when we wrapped up that fund and said, what are some of the things that we learned? How do we want to tweak the thesis for Fund Two? One of those learnings was around geography. And we did see some pretty interesting and attractive deal flow without even really looking for it that hard come to us from both Canada and from the UK. And so for Fund Two, we are geographically open to the US and Canada and UK.
Oh, fantastic. So you want to put a team there, or is it something your operational can handle from US?
In terms of having teams in Canada and the UK?
Yeah.
No, our team is US based. Because of the way our model works, the actual operator, the entrepreneur who's running the day-to-day of the business, they're always going to be there co-located with the business. So your CEO is on site. Our team may conduct a periodic site visit, but it's much more about communication with that leader, which is very conducive from wherever.
And how is then the partnerships between you and the entrepreneur? So if we can, maybe you can explain a bit about the debt part of it, or how it's syndicated. Is it fixed rates? How is the payback cycle of it? Because if you have a private equity miniature model, there's very often some financing involved here. And what is the life cycle of a fund? Is that like 7-10 years, similar to a private equity, or how is that?
Yeah, it's a 7-year life, and I'll spend a minute talking about the mechanics with the entrepreneurs, since you ask. It's maybe a little bit weedy, but I actually think it's a key sort of advantage structurally of the thesis that we're after. So we use an instrument that's called participating preferred, and that basically has 3 components to it. So, our fund will make an anchor equity investment in one of these deals, usually to the tune of about $1 million. We receive a pref or a preferred return on that money that's typically in the 10 to 15% range, depending on the deal. And then we also have a 1x liquidation preference. And so we're entitled to get 100% of our invested capital back plus any accrued and unpaid pref before the entrepreneur gets any upside from the business at all. So, you have a senior lender with that SBA loan that's first in the capital stack, but our preferred shares sit directly behind that senior lender. So we have some insulation there. Now, because of that relatively high pref and liquidation preference, the entrepreneur has a fairly significant incentive to return our capital sooner rather than later. And when that does happen, the third part of participating preferred is that our shares now convert to common shares, and that happens at a stepped up basis. And so, now a few years in, we've gotten our money back, we've gotten our preferred return paid. We get to hang on to an equity stake, and really an expanded equity stake in that company, wherein we'll participate pro rata in operating cash flow distributions, and eventually, of course, when there's a sale or an exit. Because we have a 7-year time horizon, not 100% of these businesses will exit in that time frame. We also have a put option that we can use to essentially proxy a sale and get bought out at the end of 7 years for those few businesses that are still in a hold period at that time.
Okay. So it's part of the strategy from the beginning, along with the entrepreneur, to have an exit plan.
Yeah, most of them are aiming for a 5 to 7 year exit.
Okay. Interesting. Fantastic. So you're about to start a new fund. Is there any changes? You mentioned you're going into Canada, you're going into the UK. Is there any other industries you're going to involve? Or maybe we can just go through some of the companies that you have invested in, and how that journey have been. I mean, I think that would be good if that's possible.
Sure. Yeah. So Fund One, we have 8 portfolio companies in there. Again, it's intentionally diversified across industries and geographies. So we have just illustrative, a couple of heavy commercial towing companies in there. We have a company that cleans cooking hoods in quick serve restaurants. We have a sheet metal fabricator, a manufacturer of specialty coated wires and cables, a 3PL, which is a third-party logistics shipping company. And those companies, they all have that same sort of through line that I described: B2B, stable profile with repeat customers year after year in non-cyclical, insulated industries. There are a couple of different strategies at play within those companies. Half of the Fund One portfolio has an explicit sort of M&A or inorganic growth thesis, where they're either directly trying to roll up an industry, or they're buying a platform and they're going to make some accretive acquisitions on top of it. And we've already seen that pan out in the Fund One portfolio. A number of these companies have completed several accretive add-on acquisitions where, we're only a couple of years into that fund, but we've already got line of sight that several of these are going to have, very nice expanded multiple type exits. Some of them are still in their transition period earlier on. We do have 1 out of 8 in the first fund that's sort of struggling, but that's why we use a fund structure, because inevitably not everything's going to be a home run, and you want those higher performers to carry the lower performers. But we didn't talk much about our team yet, but we do have a team here that includes several folks that have acquired, grown, and exited businesses themselves. So we have the ability to kind of swoop in and provide more advice and guidance to those portfolio companies in need. So feeling good that we're going to turn around that one that is struggling. So in Fund Two, having sort of proven out the thesis, we know we can generate the type of deal flow in the specific niche that we're talking about. We know we can achieve the economic terms that we're after to hit the type of returns that we're aiming for. So we're scaling up a little bit in Fund Two, aiming for 20 portfolio companies. A few minor tweaks to thesis. Like I mentioned, we're expanding into the UK and Canada opportunistically. We're also going to look at some slightly larger deals, maybe 4-5 million in EBITDA, when the scenario is right. So, if their entry acquisition multiple is still relatively similar to that 3 to 5 times range that we focus on, certainly we'll look at those deals. But, beyond that, We're very happy with the thesis, and we're more or less rinsing, repeating for Fund 2, which, as of the time of this recording, we're about 25% of the way into the raise. So $20 million raise, 20 portfolio companies. We're 3-ish months into that now, and have several portfolio companies already acquired. So Fund 2 is out of the gates running.
Oh, fantastic. Congratulations. Congratulations. I think if our audience have any questions, I think it would be a good time now. I can just see if Felipe, if you can list if there's any questions, we can address them as well. And I think just in more general terms, Jason, some of the businesses that you mention here looks like, it's not technology firms. It's very traditional supply B2B firms as you describe them. Do you have anything in the tech sector, or is that something you avoid?
We're very explicitly not in the tech sector. We think that just moves too quickly. It's too highly disruptible. Certainly, there are fortunes to be made in that space, and we've seen that time and time again. But it's very much a strikeout or a home run kind of outcome.
Yeah.
And our model is very much, we're trying to hit doubles with every at bat and never strike out. And we may have the occasional triple with some of these businesses that acquire and they wind up selling to private equity, but we're not at all in the tech space.
No. Okay, good. Thank you. And how sensitive is it to interest rates now? I mean, this is something that in the macro world, everybody is discussing what's going to be the next move on interest rates.
Yeah. I mean, certainly there's some exposure, right? These are using leverage up to 80% sometimes, and the SBA loans are almost always on a floating rate structure. However, we've been acquiring them in this elevated rate environment. So it's the most likely scenario is we either get stability or falling rates, in which case we're absolutely going to be the beneficiaries of that. Should it wind up going the other way and rates actually elevate, we do have a fair bit of insulation there. I mentioned I come from commercial real estate on the investment side of things, and so that's sort of my analogy that I go to. But investors that know that space will know that the debt service coverage ratio, which is a measure of how much additional cash you produce over what's needed to serve the debt, in commercial real estate, that's like 1.25 times. So you got 25% more cash than you need for the debt. In this small business space, we're usually talking about 2 to 2.5 times. So there is a pretty significant amount of excess cash being produced relative to the debt service. So should we have an increase in rates, there's a pretty good margin of safety there.
Okay, fantastic. Thank you. Felipe put up, there's a question here. What is the difference between traditional search funds and Fruition's capital model?
Yeah, that's a good question. So for those who know this asset class, traditional search funds have been the main model for the last roughly 15 years. In that model, a fund is raised and they go out there and find a bunch of MBAs who want to search. They're paying them a salary for 2 years and they're paying for the broken deal costs. When that entrepreneur finds a business, that search fund brings the debt, they bring the equity. And at that point, that entrepreneur becomes sort of a hired CEO. Maybe they have 20% upside. But the search fund, almost like a VC model, they're taking a lot of zeros. I think the stat is about 60% of searches fail. And there's 2 broken deals for every deal that goes through. So that search fund is eating a lot of cost and using up time on the front end where there's no returns. It is, however, proving out on the back end. I mean, search fund returns have been fantastic for the portfolio companies they acquire. So in aggregate, they're being very successful. How we've sort of twisted that model a little bit is our capital goes in right at the time that a deal is closing. And so our fund has no exposure to that failed search cost. We have no exposure to broken deal risk and cost. And the trade-off is we're taking a smaller piece of the overall economics than a traditional search fund would. But again, if we're trying to hit doubles with every at bat, and this model sort of enables our zero strikeout mentality, and so that's sort of the key difference in those 2 models.
Okay. There is, now you mentioned that you remove some of the risk in your structure. So what are the key, there's another question, what are the key risks involving in the strategy?
Yeah, I think there's a couple. So number one, we are talking about smaller enterprises. So with that inherently comes some risk. Probably first and foremost is key man. You do have one individual entrepreneur who is buying this business to own and operate it. And in the segment we're talking about, there's at least one layer of management below that. But I think we can all, look each other in the mirror and say, if that entrepreneur got hit by a bus tomorrow, or heaven forbid you wind up partnering with an unethical actor, that could certainly be a bad scenario. And so you put certain protections in place, but you definitely have to understand that there is some dependence on the individual entrepreneur running the business.
Okay.
The diligence on the front end of that is hugely important, and I think also that's part of why you put it in a fund structure, right? Because if you have 1 out of 20 where something crazy like that does happen, it's buffeted by the rest of it. And probably the second main risk is leverage, right? We are using roughly 80% on the acquisition level. And so you mentioned exposure to interest rates and all that. Anytime you're using leverage in a business model, it creates risk. And because there is leverage used at the individual acquisition level, we don't use any at the fund level. The fund is just straight equity to help mitigate that. But I would say key man and leverage are probably the two primary risks in the model.
Okay, fantastic. There is actually a question that is not a question. It's someone, Scott, that say might be interested to invest in soon or in the near future. What is the allocation? Maybe you can, how is the SPV structured? So for an investor, and secondly, what are the access? What's the ticket size that you're raising in a fund where it's a 20 million target?
Yeah, so we have a minimum investment of 100,000. The structure is your fairly traditional 2 and 20, where you have a 2% asset management fee. We have an 8% preferred return, so all cash to the LPs up to an 8, and then we have an 80-20 split thereafter. We're targeting a 24% net IRR to our LPs and a 3.2 equity multiple. And I'll also mention we do also have what I call the home run clause, which is that if at the end of the fund we're delivering a net IRR that's north of 25% to our LPs, that 80-20 flips over to a 50-50 after a 25 IRR.
Okay. And what's the vehicle where it's that domiciled, or how is the LPGP relationship here?
Yeah, it's set up like any traditional private fund is. So the fund itself is an LLC, and the investors become the limited partners in that LLC. We have another entity that's the fund manager. Investors get pro rata access through that vehicle to every investment in the fund. Doesn't matter if you invest now and we have 4 portfolio companies, or you invest right at the end when there's 20. Every investor gets exposed to every business in the fund.
Sure. And how do you keep your investors informed? I mean, what's the communication? Because I understand that it's private assets, so there's not necessarily that much movement in the price or the value or the underlying value of the investment. But how is the reporting?
Yeah, we're very much a full transparency shop. So we get full reporting and financial packages from every one of our portcos quarterly. And like I mentioned, on the vast majority of these, we're on the board as well. So we've got, very good oversight to what's going on. So we produce quarterly updates for our investors. It's a combination of summary financials. Will show top line revenue, bottom line earnings, and distributions for each portfolio company. And then we have a section below with some management commentary about what's going well, challenges, additional acquisitions that are happening within the portfolio, and that sort of thing. Behind that, we have the full financials for every company. Should any of our investors be curious and want to go deeper, that's available. But I think in general, most folks tend to focus on that summary financials and commentary that we provide quarterly.
Okay. Very, very well. Thank you so much, Jason. We got covered a lot of ground today. How is if we just go back to the investors before we end here. What's the normal investors that you are engaging with? You mentioned you go down to $100,000. That's a minimum investment, but is it mainly people that have that come from its family offices, or it's high net worth individuals? What kind of investor combinations do you have in your cap table?
Yeah, it's really a mix on two dimensions. So we do have some high net worth, ultra high net worth individuals. We do have some family offices. Those are the primary two types that invest with us. From a background perspective, I think it's mixed there as well. We have some folks that have, comfort and experience with alternative asset investing. They've been in commercial real estate a whole bunch, or they've done some, oil and gas or alternative energy investments. But they don't have exposure to businesses or small businesses specifically. And so we are adding that additional diversification to their portfolio. The other piece of the puzzle is we have plenty of folks who have in their own past bought or built and eventually sold a business and have, a major liquidity event from that. They understand the wealth creation opportunity that exists in business ownership, and they're looking to redeploy capital in that space without having to go and operate a business themselves again. So it's a pretty good mix of those who come from business and are redeploying capital here, as well as those who generically enjoy alternative assets with, cash flow and direct ownership and tax advantages, but don't have exposure to small business as an asset class.
Sure. That makes perfect sense. Thank you so much for today, Jason. If there's anything else you think we should cover, let's bring it on here. And otherwise, I think we really got to learn much about Fruition Capital and the opportunities that you represent here.
Yeah, no, I appreciate you having me on. I'm sure we'll be sending out additional information for attendees, but they can always find me on LinkedIn, Jason Ehrlich, or you can visit investors.fruitioncap.com to learn more about what we're up to.
Fantastic. We will add that to the recording so our viewers know where to reach out.
Great. Well, again, thanks so much for having me on today, Soren.
It was a pleasure. Thank you for coming, and looking forward to see you next time.
Thanks.
Okay. Have a good one. Thank you, everybody, for joining. Have a good afternoon.